Hi everyone, we're just going to do a quick audio test. If you can hear me, please type yes into the chat box. Thank you. All right, thank you for joining our webinar today, Donor Advised Funds, a Change in the Air. Today's webinar program will be presented by Withum's Israel Tannenbaum and Sefer Shaw's Doug Mancino. Also moderating will be Rich Ruvelson from Withum. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. At the bottom of the toolbar, you will see a question box. All questions pertaining to the webinar content should be asked there. We will do our best to address them. Be sure to answer all 5 polling questions today to ensure that you receive CPE credits for the session. Once the webinar is over, there will be a pop-up asking to complete a survey of today's session. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. And with that, I'm going to turn it over to Rich.
Okay. Ashley, thank you. And I want to thank all of you for joining us today. And I also want to thank Doug and Izzy for joining us and participating in this webinar. I'll give a couple brief introductions. First of all, Doug Mancino is a partner at Seaforth. And Doug and I have worked together as we've worked on clients together, and we have over the years, in addition to working on clients together, I've been a client, and also we've advised each other informally on some matters, and so it's been a great relationship. Doug is one of the most well-known attorneys practicing in the tax-exempt arena, specializing in healthcare. However, he is really a jack of all exempts, and he and I have worked together. Give you an example with a large family foundation. We've worked together on a country club, a non-hospital healthcare charity, and on a large federated fundraising agency as well. And it has always been a great experience for me, and I hope for Doug that's been a great experience, and it's been good for our clients. Doug is also a very well-known speaker and author, and is the author of Taxation of Exempt Organizations, published by Thomson Reuters, which is updated twice a year, I think. And yes. Doug is currently working on the latest version of the updates as we speak, almost. So thank you for joining us today, Doug. It's a great honor. Izzy Tannenbaum, Israel, has over 17 years of experience, both in Big Four and national firms. And we're happy and excited to have him here at Withum. He works both with nonprofit organizations and benefit plans, and he's got a lot of experience. Great to work with. He is very active in both the New York CPA nonprofit activities, as well as the AICPA tax exempt committee. And so I will, with that, I'm gonna just, talk about very briefly we start out with this report on DAFs that was published by the National Philanthropic Trust. And they're a DAF that's over $8 billion of assets. And they do this annually. It's a great resource. And they're a great organization. But, so they've gotten information from over 1,000 sponsors of DAFs. And for the 2020 year-end fiscal year. And so we've got, included on this slide, the highlights of that information. And, as we get into this, and one of the things that I really want to emphasize is that, they point out the size of both DAFs and private foundations. And, we look at DAFs and addressing issues with DAFs. And of course, these issues with DAFs have been on the table for a number of years. Some of the issues that are being addressed. But the issues with acceleration of contributions, some of the things we're talking about today and the concerns can also apply to private foundations. So, with that, before, I just want to go, we're going to jump in with polling questions. And it's hard because we're trying to have somewhat of an unfiltered, a normal discussion. The polling questions may get a little bit awry with respect to ordering, but we'll try and fix that, but they will all get asked. There will be 5 polling questions and you'll need to answer them all 5 to get your credits. So with that, we're going to answer, before I turn it over to Doug, we're going to ask the first polling question. So Ashley. Okay.
All right. So the first polling question is launched. National Philanthropic Trust's DAF report examined how many charitable sponsors of DAFs, ? Nearly 20, nearly 75, nearly 250, nearly 1,000. All right, and we're going to close it up in just a second. So just get those last minute votes in. Okay, and we're going to close it up. And the results are in. It looks like 63% of you voted for nearly 1,000. And then right behind that is 31%, nearly 250.
And nearly 1,000 is the answer. And with that, I'd like to turn it over to Doug to ask you what stands out when you look at, this report by National Philanthropic Trust. What do you see as the keys there?
Well, one of the things that this report does is it compares the average size of DAFs with the average size of private foundations and the aggregate amount of assets that are held by private foundations, which number about 90,000, with the number of DAFs, which number about 1 million. And my reaction to that statistic was simply that it's completely unsurprising because DAFs have only really been around since probably, I'm going to excuse myself. I've got bronchitis, and so If I have to go and mute to cough, I will do that to avoid disturbing you all. But basically, private foundations, the first private foundation was formed in the late 1800s. And private foundations of really high net worth, like Carnegie Corporation of America, the Ford Foundation, and other organizations, the Rockefeller Foundation, those were formed in the early 20th century. And they were formed by substantial gifts by substantially wealthy individuals and have only grown over time. And then you think about the more recent major philanthropy, the Gates Foundation, the Buffett Foundation. All of these are foundations created by multi-billionaires. So it's unsurprising, and they're created as private foundations because those donors want to have direct hands-on control over the activities funded by the foundation, irrespective of, in many cases, irrespective of the views of the original founder, if you take a look at the Ford Foundation by way of example. DAF, in the contrast, probably really never caught ground until the mid to late 1970s. That's when the Internal Revenue Service, post-Tax Reform Act of 1969, issued final regulations in the private foundation area, setting forth criteria that would be used to determine whether a donor had made a completed gift to the private foundation. And I frankly was personally involved with one of my early mentors when I was back in Cleveland, working on the creation of the first DAF for one of the Jewish community federations. And basically, it was refining the nature of what kind of influence versus control an individual could have over the distributions of a DAF. So that's an important factoid. And then also, in reality, for a number of years, advisors like myself would counsel about using DAF if you are making total contributions of, say, $1 million or less. And the reason for that is once you hit that $1 million threshold, then it becomes more economic to set up a private foundation, a family foundation, where you can have direct control over the investments and grant making, including yourself and your family. And so that's where I think the fact that there are 1 million plus DAFs and only 90,000 private foundations, but the balance of assets is over with PF is unsurprising to me. But DAFs are increasingly an important type of philanthropy for even large donors. If you witness the case of the couple in San Francisco that recently litigated a case against Fidelity, and that's why you can learn about this information, which would not otherwise be readily available. They were contributing a couple $100 million of shares of a newly publicly traded company. And they did so probably because there was a timing issue relating to get a gift completed by year end, with not enough time to have the assurance of having a determination letter in hand from the Internal Revenue Service, recognizing the tax exempt status of a private foundation. So I think the bottom line here is that DAFs today are very different from what they were 10, 15, 20 years ago. And we'll talk about this a little bit later in another segment, but we'll talk a little bit more later about the comparisons of DAFs v. private foundation in more detail. Back to you, Rich.
Okay. Izzy, do you want to talk about what stands out to you?
Yeah, absolutely. I think, when you take a look at this report, it really just looks like the country's fastest growing means for charitable giving is growing even more faster. A few items that I kind of noticed when going through this report is that grants grew 30% faster than contributions in 2020, and grant growth has really outpaced contribution growth for 6 of the last 10 years. At the same time, total grant making from DAFs has increased fourfold over the past decade. One of the other things I noticed is that the grant payout rate, so really the percentage of total charitable assets at the end of the year that a charitable sponsor grants from a DAF to an actual qualified charity, increased to 23.8% from 22.3%. And it looks like the DAF grant payout rate has exceeded 20% for pretty much every year on record, which I think is demonstrating that DAF donors are a consistent and sustainable resource for charitable support. This is really in opposition to what we'll talk about in a little bit coming up in terms of the acts that are presently going to be before Congress, just in terms of what their goal is and what they're trying to achieve and what they would say in terms of lots of funds that are just put into DAFs, but then ultimately just sit there and are not paid out, being that there is no actual legislated requirement for them to pay out these funds at any given time frame. The report really going through it, if you look at it and just look at the overall industry in general, it does point out that maybe more of the problem lies with some of the major private foundations. This is something Rich and I were talking about a little bit earlier, wherein they do have much more in terms of assets than any donor advised fund sponsor individually. I believe the report put it that DAFs granted half of the dollar amount that private foundations granted, while having about 4.5% of private foundation assets. So really what we're seeing here is that DAFs seem to be giving a lot, and a lot more than the minimum that's required by actual laws for private foundations. Now, it's probably worth noting that, as Rich mentioned earlier, NPT does have some skin in the game. They do manage donor advised funds. So, that's just something in terms of the larger context. But I think it's clear that from this report, DAFs are giving at a very high rate, probably more than would be instituted, and as we'll talk about, more than would be instituted based on what they're proposing as legislative changes. And I think it also points out that DAFs are a great tool for responding to crises that may develop, such as COVID-19. If you look at the numbers in the report for DAF contributions versus foundations, you can see that there was a lot more support coming out of the donor advised funds. And in many ways, people would argue, to make a counterpoint, that by allowing donor advised funds to accumulate these amounts and accumulate earnings on those once they're invested, this allows them to respond quickly and efficiently with something like the COVID-19 crisis when things are really needed. So overall, I think this report does put a really good frame around how DAFs are being used, their strong support of charities, and their ability to really adapt to different given situations. So I think what we're going to see from this is that there's a lot of differentiation between what the numbers are showing in this report and what's being proposed, as we'll get into a little bit later.
The other thing I just want to briefly mention is that, DAFs have come in and they've, with respect to public support, and, they've provided a lot of flexibility to publicly supported charities, to their grantees. And that they've been, in addition to the payout rate, there have been some other things about DAFs that have been positive. One is the class public support issue. That's been useful. The other thing is that large DAFs, for example, have been useful to a lot of organizations that, even in the pandemic, businesses that wanted to do, run employee assistance programs. A lot of them were able to use DAFs. I've had clients that have wanted charitable efforts, fundraising efforts, sort of, I guess, popular culture fundraising efforts. They've looked to DAFs for fundraising because DAFs are already, the larger DAFs are already registered to solicit funds. across the United States. So that's been useful. And we've seen some other areas of concern where, for example, in the environmental area, where you've had a few key players in an industry wanting to fund some mitigation efforts. They've turned to DAFs. And that's been because of that whole public support advantage. So, they have been useful in other respects. Let's go back to Doug. You talked a little bit about private foundations versus DAFs and where you saw it, and you mentioned $1 million threshold. I would add that I look at what they want to invest in, what are the assets contributed as well. Anything else you look at, when you talk to clients, and then Izzy, you can jump in after Doug.
Sure, Rich. This is in a first instance, it is a situation where the size of the gift matters. If you look at those statistics, the average commercial DAF is about $160,000. The average DAF maintained by a community foundation, most of which were early entrants into this area, well before the commercial DAFs came into this space, is $543,000. And in neither of those cases could you realistically justify the use of a private foundation from a compliance standpoint, return preparation standpoint, compliance with self-dealing and other issues that are required and very serious compliance issues in the private foundation area. And I would actually revise what I said earlier. I think today, my guess is that absent special circumstances, which I'm going to touch upon in a moment, I would be reluctant to use a private foundation that would ultimately have assets of less than about $4 or $5 million. Although I would say this, the cost of compliance has decreased considerably. I entered into practice in 1974 and was very much involved with implementation of the regulations as they were being proposed and finalized under Chapter 42 of the code, which regulates private foundations. And there was a great fear of the complexity of those rules, the negative implication of footfalls that could result in financial consequences to the substantial contributors to those DAFs, that is the founders. And today, while the rules have only changed somewhat, they were basically modified considerably in 1984 to eliminate some of what I would call draconian issues and do some cleanup issues. In today's environment, as we sit here in 2021 and going into 2022, advisors are much more comfortable dealing with the private foundation rules. In a moment, I'm going to comment on the unique rules that now apply to DAFs and make some comparisons there. And so I think that I look at this issue, or I try to look at this issue objectively and learn what is the desire of the contributor in terms of what they would like to accomplish through their philanthropy. And an example of that, the next point I want to make is that what is the ongoing role that the donor would like to have? There are some donors who want to simply use the DAF as semi-responsive in the sense that they get a request for a charitable donation, they go to their DAF, fund it, they do whatever basic due diligence, and the DAF sponsoring organization does that as well. But they are sort of across the board, and there are many family foundations that do the same thing. They make the same grants year over year to the same organization. You contrast that with even small organizations. I happen to be on the board of the Irvine Health Foundation, and we are a very hands-on organization. And even though we're small in scale, with 12 or 13 million dollars, the fact of the matter is that our aim, and ever since inception, has been to punch above our weight, be influencers, even though we can't make the multi-million-dollar grant that other foundations that are considerably larger, $1 billion or more, can make. We play a hands-on role, our staff and as well as the board members. And so it really depends on the mental frame of mind of the individual or family that wish to conduct philanthropy through either a DAF or a private foundation. The third thing that I wanted to mention is that the lines began being blurred between private foundations and DAFs when the Pension Protection Act of 2006 was enacted. The key thing that act was in large reaction to a lot of real and perceived abuses of DAFs that preceded its enactment. One example I'll give you, and this is for the professionals' benefit, not for the lay people, although you can look the case up on Google. There was a decision in the United States Tax Court called Viralum, V-I-R-A-L-U-M, V Commissioner. And that unveiled the whole area of abuse potential in the DAF space. A promoter, and I use that word precisely because they were nothing more than a promoter, formed a purported public charity supported publicly supported organization, and then convinced primarily physicians to make gifts to DAFs. And they promoted DAFs as ways of essentially employing your children, to do philanthropic work, to make loans for educational purposes to your children, and so forth. And why Viralum is a very good example of abuse. Basically, the donor had appreciated property, real property, so that would not be a suitable gift to a private foundation because the contribution would be limited to his adjusted basis rather than fair market value. So he gets a fair market value charitable contribution deduction. And then in conformity with the operating procedures of the sponsoring organization, doctor, and they were both doctors, the doctors Viralum made scholarship loans for their daughter to go to University of Pennsylvania, and also for their son to go to the same institution. And the theory was if they had to do charity work, a certain number of hours of charity work, in which case the loan would be forgiven. But the point is, it was making a loan to a family member. So when you now look at section 4958, which is the excess benefit transaction rules, in 2006, the Congress added a new provision that applies to DAF section 4958C2 that parallels the self-dealing rules that apply to private foundations, but in some respects it's better, and in other respects it's worse. And what do I mean by that? Well, the key thing is that this provision treats as what's called an automatic excess benefit transaction by a DAF with a substantial contributor. And let me add that the definition of substantial contributor is the same that applies to private foundations, and it's very low. You could make a $5,000 or $10,000 gift to a DAF under these circumstances and be treated as a substantial contributor. And so what it does, among other things, it prohibits the payment of compensation, the making of loans, or engaging in similar activities as between a DAF and a substantial contributor. Compare that with the self-dealing rules that apply to private foundations. The most important exception from self-dealing is the exception for the payment of compensation for personal services actually rendered. So if you look at many family foundations today, particularly second and third generation, you'll see that the son or daughter or great grandson or granddaughter or all of the above are compensated executives of the private foundation, all in compliance with the self-dealing exception for personal services, assuming compensation is reasonable. Those would be automatic excess benefit transactions in the DAF context. And what that means is that whether say the compensation is reasonable or not is irrelevant. What is relevant is that once you make the payment of compensation to a substantial contributor or to a family member of that substantial contributor, and that would include entities controlled by that substantial contributor, 100% of the amount paid is treated as an automatic excess benefit, meaning that it has to be repaid in full. Otherwise, and the individual gets hit with a 25% excise tax on that amount. So let me illustrate. Let's assume that the donor to the DAF desires to hire a family member for $100,000 a year. That $100,000 in its entirety would be treated as an automatic excess benefit, requiring the individual to repay it. The individual also would be subject to a 25% excise tax, and advisors to the DAF would be subject to a tax if they knowingly approved that kind of an arrangement that results in an automatic excess benefit transaction. And if you don't correct, the penalty excise tax jumps from 25% to 200%. So, what my point of getting into granularity here is that it's very important for particularly the advisor to understand really what the desires and intentions of the individual or founding the DAF would likely be, because you can go in one direction. Now, what I will say is this: I have other high net worth individuals who love DAFs, mainly because they can make a contribution to a DAF, and then the DAF makes contributions to other charities essentially anonymously. When you look at a Schedule B of the public charity that is the recipient of the grant, it will name the donor advised fund sponsor, but it won't name the individual. Now, that desire for anonymity has been mitigated as of this year by the US Supreme Court, which held unconstitutional the requirement by states like California, New York, New Jersey, and I believe Illinois, and there are others, that required them to file Schedule B of their Form 990 with the Attorney General's office, and that would have made it a public record. And then one last point. My last point is looking at the nature of the property that the individual wishes to contribute. As I alluded to earlier, an individual can get a charitable contribution deduction for the full fair market value of appreciated securities that are publicly traded when that gift is made to a private foundation. But he can't get a gift at fair market value for contributions of real estate, closely held corporate securities, artwork, other kinds of things that would be deductible if appropriately structured when made to a private public charity like a DAF. And so, and that actually is the reason why DAFs are increasingly getting contributions of unique type of assets rather than cash or securities. So again, my last point here is understanding the real intent of the donor and maximizing the choice of recipient selection. And in that respect, DAFs somewhat tip in favor of the use as opposed to private foundations when we're talking about the use of appreciated property to do the funding of it. Back to you, Rich.
Izzy, you want to jump in?
Yeah, absolutely. So, I'll approach it because I think that was those were some really great points, Doug. And so just looking at it also from a tax perspective, the strategy really of separating the timing of a charitable deduction from when the funds actually go to the charity, it's not unique to DAFs, right? That happens by private foundations too, because the donor is taking that upfront deduction. And although they do have a required annual payout, those don't necessarily need to be directly correlated other than 5% of the total throughout the year. But overall, the reality is that for private foundations, to Doug's point, these are significantly more expensive to operate compared to a donor-advised fund. Potentially have an excise tax on investment income, which a donor-advised fund does not. Have a requirement to distribute, which we talked about, that a donor-advised fund doesn't as well. And to the other point Doug made, really are subject to lower limitations in terms of the deductibility of the contribution. So in terms of looking at it when you're trying to determine whether to advise upon a donor-advised fund or a private foundation, I am seeing, to the point Doug made, more people biting at the donor-advised fund, where private foundations are really only getting used when there's a really compelling reason to do so, such as making grants to individuals in certain situations would be easier through a foundation, retaining greater control over the investments or assets, or being able to compensate people, even in light of the self-dealing rules, as Doug talked about. Ultimately, I would say the same thing, that donors really need to analyze and almost work backwards. What are my charitable goals? Is it just a deduction? Am I actually trying to achieve something? Am I actually trying to bring the next generation in and build legacy? And ultimately, that's really what will be able to dictate what makes the most sense in terms of charitable vehicle. But at the end of the day, and I think Doug made this point really well, if there isn't a certain minimum level of funding, and I think that is the right number, around $5 million, then a foundation really doesn't necessarily make sense. Again, there can be compelling reasons to do so in individualized cases, but overall, it just seems like donor-advised funds have been a really great and more efficient tool for high net worth individuals and other organizations to really be able to give charity. And as we saw from the report earlier, actually make sure that those dollars do go to qualified charities. So we'll talk a little bit in a bit about how these proposed regulations may affect that going forward. But for now, I typically, again, unless there's a compelling reason and the charitable goals of the individual dictate it, I would say that most people would be better suited, at least at this point, for a variety of reasons, by a donor-advised fund.
Yeah, I think that's a great point that both of you made, is that it depends on more facts than the size of the anticipated contribution or amount of money being contributed. And, it depends on, what the legacy you're intending is. And do you want your children, grandchildren, do you want people, do you want them to compensation for services? What's the property being donated? Is it a complicated gift? And, for example, is it a gift that might have some UBIT potential through debt finance property, etc. So, it's something you need to consider all of the facts. And, for those of you who are professionals on here, and there are many, you really have to talk to people. You can't just look at it and say, hey, it's $5 million or less. Look at all of the facts. Look at what their intentions are. Look at what they want to accomplish. And so with that, I think that we will go to the next area. This is where you can find the study. If you go to NPT's website, and we're appreciative of the fact that they let us discuss it. But one of the reasons this is topical, a lot of you aren't aware of these proposed regulations. But of course, the ACE Act proposal by Senators Grassley and King got a lot of attention. One of the reasons being as well, not just because of what it's doing and addressing donor advised funds and the acceleration of charitable spending by DAFs, as well as addressing it by private foundations. But the other thing is simply bipartisan legislation. So we have someone who doesn't consider himself a Democrat, but caucuses with the Democrats, and a Republican coming together on legislation. And so that's the reason, though, apart from the topic, it's gotten a lot of publicity. And before we jump into it, let's just go to the next polling question.
All right, the next polling question is launched. Charles Grassley, is Grassley the right way to pronounce? Republican, Iowa,
Yes.
has served in the U.S. Senate since 1981. True or false? And this is polling question number 2 out of 5. So just get those votes in. I'll give it a few seconds. All right, and we're going to close it out. Let's see what the results are. So 91% voted true.
Okay, and all right, and that is the correct answer. You can tell we were concerned where we would be when we were putting the questions in. We weren't sure, given the nature, so hence the question. And for those of you who are curious, his 40 years is only puts him 10th in terms of seniority with respect to members of the Senate, the longest having been Robert Byrd of West Virginia, if anybody is interested.
But he is running for re-election next year.
Yes, that's right. So that would leave him 4 years short, so he'd still have to do 2 terms. It's the kind of record, out here in Washington, D.C., everybody tracks Alexander Ovechkin and where he is in trying to pass Wayne Gretzky. A lot of people in Washington also track the length of time members serve in the Senate. So with that, we'll start talking about the ACE Act, and I will turn it over to Izzy. We'll start with Izzy this time. Tell us what you think about the ACE Act and, the different DAFs and the rules impacting PFs. What do you think?
Yeah, absolutely. So just to make sure for those who are unfamiliar, under current law, as we discussed and we know, DAF holders will receive the full tax benefit for their donations up front, but as we discussed, aren't required to have any sort of annual payout. As proposed comes the Accelerating Charitable Efforts, or the ACE Act. Essentially would reform the law to require DAFs to disperse funds to nonprofit within what they call a reasonable time frame, and what that is, can be open to interpretation. But essentially, the idea being to accelerate giving. The main complaint that has been out there for years, or I should say, the loudest complaint has been that people give funds or private foundation park their funds in these donor advised funds, and then they just sit there because there is no required payout. So to that end, the bill essentially establishes 2 types of donor advised funds: a 15-year donor advised fund, under which a donor would receive upfront tax benefits for their contribution only if the funds are distributed within 15 years of the donation. Alternatively, they can release their advisory privileges on being able to say where the funds go, and that as well will provide an upfront tax benefit. And the other type of DAF it's going to create would be a 50-year DAF, under which essentially a donor would receive any capital gains or estate tax benefits on donation, but wouldn't actually receive the income tax deduction until the funds are distributed by the DAF. All would ultimately have to be done within 50 years. And ultimately, after looking at this, although the act is called the Accelerating Charitable Efforts Act, in light of that report we've seen and a couple other reports that are out there, it seems to be focused a little bit in the wrong areas, because as we talked about some of the statistics earlier, there really does seem to be a large amount of DAF funds getting paid out, really in excess of the private foundation, which is what I would say is the model in terms of idea of having this required payout annually. I believe there was additionally a report by the American Enterprise Institute, which said something like the payout rates of 13 of the 15 top foundations were significantly less than the growth in financial assets that they experienced. And I forget the exact numbers, but it was much less than donor advised funds. I think one of the ones they were talking about, and this was a major foundation that had signaled its support for the ACE Act, which, as we discussed, only targets donor advised funds. But I believe the foundation itself had a payout rate of about 5.3%, according to the 990 for 2019. And obviously, this is just 0.3% above the required 5% payout. So I think, if you look at the actual numbers, donor advised funds having average payout rates above 20% for the last 5 years, like we talked about earlier, this being much higher than all of the country's largest foundations, I think maybe there needs to be a little bit more focus, not necessarily in pushing the funds out of the DAFs, but maybe on the foundation side. And the other thing that I would note about this report, in light of the ACE Act, is that the increase in donor advised fund giving during a time when we talked about this a little bit during the pandemic really demonstrated the value of having those donor advised funds in place. Once the pandemic hit, obviously the world changed. People needed to be a little more careful with where they were spending, but these funds had already been given, right? There's no, I'm going to give less this year because my business is struggling, because I'm personally struggling a little more. These funds were there, they were allocated, the earnings on them were allocated, all sitting there waiting to be given out. And based on the numbers, it looks like that really is what took place. So I think overall, there are some provisions in the act that will be beneficial, but I think perhaps it needs to be expanded a little bit and a little less targeted, just in terms of the idea of getting donor advised funds to push that money out there, when it looks like a lot of this money really is going toward the right purposes in what I would call a reasonable time frame. But again, that's ultimately the definition of that is what's going to be decided by Congress when they evaluate this act.
Doug?
So
Your
my
thoughts?
reaction to the ACE Act is that it is extraordinarily complex, fundamentally unworkable, and the best thing that can be said for it is that it has stimulated the DAF industry, so to speak, to begin self-regulation. I think the discussion and debate about deferring the timing of a charitable contribution deduction has made and frankly, Chuck Grassley's significant record in regulating the charitable space in the writ large. He was one of the primary drivers of the Pension Protection Act of 2006, where there were significant reforms added to DAF definition and regulation, supporting organization, regulation and definition, and numerous other elements of the charitable sector that were perceived to be areas of abuse prior to 2005, because the Pension Protection Act was actually added as a Senate amendment to TIFRA, which is a bill that was enacted in 2005. But long story short, my point is simply this. we're already seeing the benefit of having a shot across the bow to DAF, particularly commercial DAFs. I just saw recently that Fidelity Charitable has adopted a new policy requiring minimum distributions from each fund rather than in the aggregate. And my guess is once the biggest commercial fund does something, the rest of the industry, including community foundations, will begin following suit. And that would be all as a method of essentially preempting the need for yet another. Listen, I make a living doing tax law, and I got to tell you, trying to sort through these provisions and the micromanaging of both the individual and the organization, and creating situations where you're deferring the ability to claim a charitable contribution for some period of time, an indeterminate period of time, all create they create a lot of work for tax advisors, but they don't really have a benefit commensurate with the cost of that. And so I believe that we will increasingly see self-regulation, very public self-regulation, as a way of preempting the actual moving forward of the ACE Act.
Mhm. You know, one thing I do want to point out that it's interesting that the ACE Act, yes, it does address some changes to private foundations, but it's really done sort of as providing carrots. You know, if you increase the, your granting to 7% from 5% of the average fair market value of your assets, will lower your 1.39% tax, net investment income excise tax, will lower that, will eliminate it. Well, it's really only a 1.39% tax. So that's not much of a, it's not much of a carrot that they're providing. And at the same time, they've really created they're trying to create something that's very complicated. And, to me, it seems like it may do more to inhibit charitable giving than it does to actually accelerate contributions by DAFs. So I think that's, go ahead.
Sorry. What I would add is 7% was what was in the payout requirement in 1969 for private foundations.
Mm-hmm.
And I don't know about anybody on this webinar, but if you could average 7% plus inflation on a consistent basis, man, I'd take that investment. And what happened, remember, there were tons of studies by objective economists that concluded that by maintaining a 7% payout rate, you essentially are causing private foundations to wind themselves down. Because if your bogey is 5 or 7% plus inflation, and think about what the inflation rate was, what it is today now, but what it was in the late 70s, early mid 80s. And that's why Congress in 1984 reduced the payout rate to 5%. And I would add that, the tax on investment income is relatively inconsequential. To my mind, it really comes into play when you're applying it to dividends and interest. It's really not much of a big deal. It really comes into play when you're dealing with capital gains, where you have significant appreciation in assets, where the meaningfulness of even a 1.39% rate becomes important. But I do think that these kind of things, though, if they were to get enacted, would raise the same kind of debate and cause Congress to go back in and amend it one more time. But more importantly, serve as a great shot across the bow and encourage self-policing and more broad publication of those self-policing efforts to not just the general public, but to the legislators who are involved with this.
Thank you. And with that, we're gonna jump to the next polling question.
All right. Polling question 3. The proposed Accelerating Charitable Efforts Act, ACE Act, includes proposed changes for both private foundations and true or false. All right, and we're going to close it in just another 2 seconds. Get those votes in. And we're going to close it and share the results. So 78% voted true.
And that is the correct answer. And with that, we're gonna go and we're gonna talk about proposed treasury regulations and talk about notice 2017-3, describing proposed guidance for DAFs and their sponsors. And as Doug had indicated, this is a long time coming. And it's been, the issuance has been prolonged even more by the fact that the person at Treasury, the attorney responsible for this, has changed a few times due to people leaving the government. And so, but we do know that they are going to be coming out in potentially the end of this year, most likely the beginning of next year. And unlike the ACE Act, this is a pretty much a known deal. So we know this is coming. And so, Doug, if you want to, start on this one and talk about 2017-73 and tell us what you think.
Well,
Liam?
first of all, the exempt organization function at the Treasury and IRS have increasingly been using notices to both provide temporary guidance as well as solicit comments concerning various issues concerning the topic that is being covered by the notice. And 2017-73 is no different from that. It does solicit comments. Well, I'm going to talk about reliance on it in a moment. It does solicit comments. That first sub-bullet point on tickets that enable a donor or donor advisor to attend or participate in a charity-sponsored event. This is an attempt to resolve what I consider to be a bogeyman issue in the private foundation sector. Going back to the 1970s, 1980s, the IRS began addressing the practice by private foundation, or the question posed by private foundation about bifurcation of gifts to charitable organizations that are putting on a fundraising event. And what bifurcation means is that the individual would pay personally for the quid pro quo benefit that the recipient organization has to identify for the charitable event, fundraiser, auction, whatever it is. And then the balance would be made by the private foundation and be treated as a qualifying distribution. The reason why I think that's a bogus issue is twofold. First of all, organizations like the Council on Foundations, which is an excellent organization, by the way, I don't mean to in any way to diminish them, based on the private letter ruling and technical advice memorandum involving bifurcation, which in my mind was very fact sensitive, began advising the foundation community that you should never buy tickets for a charitable event through the private foundation, notwithstanding your attempt to bifurcate it. This is now migrated over to donor advised funds, the same issue. And they're soliciting comments on that. So whether it makes it to the final regulations or not remains to be seen. But I think that's a very, troubling, again, a shot across the bow to contributors to donor foundation, donor advised foundations, donor advised funds, to not use the DAF to purchase tickets. The second thing that I would add here is reliance. In January of 2021, the IRS finally issued final regulations involving the excise tax on compensation in excess of $1 million that's paid by virtually any type of charitable organization, public charity, private foundation, certain governmental organizations, and the like. The point here is that when they finally issued the final regulations, the kind of guidance they did is as follows. First, Notice 2017-3 itself says that you can either rely on a reasonable interpretation of the statute or the notice, as long as you do so in a consistent manner. When proposed regulations were issued under 4960, they said you can rely on the reasonable interpretation of the statute, Notice 2017-3, or the proposed regulations, as long as you use it consistently. In other words, you can't cherry pick which portion of one of these multiple pieces of guidance can be relied upon by the organization. And then the last thing that I believe is probably likely, because we saw this with the excise tax on compensation in excess of $1 million, is the IRS said that in response to comments, they would give a year for organizations to essentially get their act in order to be in compliance with the final regulations, because thereafter the final regulations would govern their behavior. Now, why is that important for DAFs? First of all, it's important because one of the most fundamental questions raised about DAFs in the notice is, what is a DAF? What is the nature of the right to provide advice that an individual has that causes an account within an organization to be treated as a DAF for regulatory purposes? Because as I mentioned earlier, some of the regulatory provisions, like the automatic excess benefit transaction rules, are quite financially significant. So I think that my view is that obviously the comment period is closed. We were speculating before the conference began as to timing. It is traditional practice by Treasury and IRS to drop final regulations or proposed regulations on Friday afternoon, immediately prior to an ABA tax section meeting. There's one of those meetings in January, and there's another in early May. And so while it's the IRS people and Treasury people have been generally mum about timing, I think it's reasonable to expect something either in mid-January, mid-late January, or early May. Rich?
Okay. Izzy, do you want to talk a little bit about the proposed regulations? Or the soon-to-be proposed regulations?
Yeah, absolutely. So, I think Doug made some great points about 2017-73. Some of the bigger ones that stuck out to me, or I guess the big ones in general, are like we talked about, which I agree is completely a shot at DAFs regarding the grantee organization being for a charitable event or membership fees, and the donor receiving more than incidental benefit. I think the approach they're taking is relatively conservative, so it would be interesting to see, and hopefully these regulations will be prospective and not retroactive, because there has been so many issues around this in the past few years. So we'll see how that shakes out ultimately. I think there was another interesting part of this notice wherein it talked about when a donor recommends a distribution for his or her DAF to satisfy a pledge that they made to a qualified charitable organization. What I really like about the way the regulations seem to be looking at that is that they seem to understand that it's difficult for a sponsoring organization to really have to get in there and differentiate between what is a charitable pledge, what's a mere expression of charitable intent. And I think it's the correct approach that leave this determination to the grantee charity rather than have the DAF have to ascertain whether this was actually a pledge and whether it's in satisfaction of a personal pledge. So I think that is definitely a great addition. And then ultimately, I think another big part of these regulations, and something we did talk about regarding the public support percentage, this is something that understandably the IRS does view as an abuse to avoid tipping. If one donor was giving money through a DAF, it would be a publicly supported, that's all good money, right? 100% publicly supported organization. If they give it directly, well, now you're a private foundation because you're limited. So I do understand that this in theory can be seen as an abuse of the system, but at the same time, I think the provision itself is very broad and does provide a lot of administrative burden. And based on what we saw in the report earlier, will likely make it harder and discourage financial support through the DAFs for many public charities, really accomplishing just the opposite of what the ACE Act is trying to, and the regulations are trying to achieve, which is to get more charitable money pushed out into the marketplace. Ultimately, we'll see how the actual rules shake out. The ACE Act in generally adopts the notices proposals, but one thing it did seem to address, and on that point I was just mentioning, is that in part address, at least with the exception that a DAF can certify it did not make a distribution based on a donor's advice, which I mentioned earlier, and therefore if the DAF's decision to provide support is independent, their donation would still be considered public support. So this is a slight update in the ACE Act versus what was originally in 2017-73. That exception, again, allows DAFs to make contributions to charity and help the organization's public support percentage. That's good money. That would be the 100% no limitation. But ultimately, it's just going to be a matter of where this shakes out in the regulation. So there are some good and positive things in there, but it remains to be seen whether this will be something that actually does spur any additional charitable distribution, or does it just now administratively burden the DAF, which was a really efficient vehicle for actually giving money and getting it out there. So we'll just have to see what the final regs look like and how ultimately that shakes out.
Yeah, and I just want to, before I go to the polling question, just want to add a little something and elaborate on a point that Doug made. This is something that by impacting public support computations like this may actually inhibit certain charitable efforts by some donors. One of the things that donors have been able to rely on through the use of a DAF is anonymity. And yeah, maybe, they're, the grantees, the donating public charities, maybe they know the source of the DAF money, but the general public doesn't have to know. And so this is something that could really have a very limiting impact. And, I think of one client in particular that is an industry effort in a particular industry and is funded by key players in the industry. And that's one of the big reasons they've been using a DAF. because otherwise it would be kind of tough to, one, it would be tough to be publicly supported for this activity. And two, they really don't want their names associated with it, even though this is a great activity. But there are reasons that they don't want to be involved. So that could be very difficult. With that, let's go to polling question number 4.
All right, polling question 4. Notice 2017-73 addresses what? Distributions from DAF funds used to purchase tickets, distributions from DAF funds fulfilling a pledge, public support computations of DAF grantees, or all the above. All right, just another 2 seconds and then we're going to close it out. All right, and we're closing the poll. So 88% voted all of the above.
And that is the correct answer. And, I think what we'll do as we're nearing the end, and of course, if you have questions, get them in. And, there aren't any yet. But, very quickly, Izzy and Doug, and I'll start with, Izzy this time. Very briefly, do you have any thoughts on, first of all, there's California's failed legislative attempts in California to introduce more transparency. And we put a slide on that at the end. But do you have any thoughts on issues or things you'd want to conclude with, put on the table?
Yeah, absolutely. I just think that, I think Doug made a really relevant point earlier when he said that this is at a minimum spurred that conversation and got this to the forefront of federal regulation. So I do think we're going to be seeing changes with this. I would say that, where the federal goes, the state will follow. So it's likely that although, like you said, California's failed attempt, but with its recent fundraising platform regulations, has clearly showed that the state itself, and I'm sure other states as well, have a renewed interest in the operations of these types of funds and public types of organizations in general. So I would imagine that we'll see a lot of this regulation come out at both the federal and then ultimately the state level as well that will govern these funds. So it's something that we're going to see changing a lot in the course of the next few months to a year, just based on the numbers that it is bringing to the forefront now.
Okay, Doug?
Well, the only thing I would say is California did enact the Nonprofit Integrity Act a number of years ago, which governs both the regulation of in-state charitable organizations as well as out-of-state charitable organizations that do business in California. And to my mind, all it did was increase the burden and drive organizations from other states that are domiciled in other states from doing business in California. And that's why I think this kind of micromanagement of a type of charitable organization is very unwise.
Okay. So with that, we'll go to our final polling question. I do want to add before we go there that it's unwise, and some of those requirements have, really put increased costs on nonprofit organizations. And really that, some things I think really unnecessary. But, it is that way. But with that, we'll go to our final polling question. And Ashley, you want to do the question?
Okay, so the last polling question, Doug Mancino, who is he? Has authored or co-authored 5 books and treatises, is active in many civic and charitable activities, is a partner at Safeart, all of the above. All right, and we're going to close it in just a second. And just as a reminder, this is the last polling question of the day. You must complete all of them to receive your CPE credit for this session.
Ashley, you going to come back to me for a second or two?
All right, everybody voted.
All right. Well, the answer is all of the above. And I want to, at this point, thank Doug especially for joining us today and adding an incredible amount that, Izzy and I couldn't have done in a million years. So thank you very much for doing that. And Izzy, thank you. This was a good program. We put a lot of things on the table. And I also think that we, presented a perspective that, is based both on experience and, both with, donor advised funds and public and private foundations, as well as working with public charities. And the fact that we've been doing it for a number of years. So I hope that you've all enjoyed today's presentation. And we don't have any questions here, which, is unfortunate. But, again.
We actually
Ashley,
do have a few. We do have a few.
Got some. Okay, they're not showing up in mine. Well, can we answer a few? Can you read the questions?
Yes. So
Okay.
one of them that came in, so we have about 3 of them. So
All right.
please explain how the NIIT is not 3.8%. That's the first one. What do we think?
I don't understand the question, but
I don't either.
Yeah, I mean, I know the individual net investment income tax is 3.8%, but the actual the NII, as it's called for private foundations, is 1.39%. It used to be 1% or 2%. And you used to have this whole section on your form that calculated that. But ultimately now it's just the one flat percentage, and that section just says reserved for future use. So maybe there was just a little confusion between that, but that would be the distinction.
Thank you, Izzy. Next
Okay.
question, Ashley.
What is the status of the ACE Act? Is it actively being considered or is it on hiatus?
I don't think that it's going to happen in this term. We do know that both senators will be back.
And it is active.
It's active, but my guess is that this will be reintroduced in the next Congress. So, next question.
And that's actually it. The last question was a repeat of the previous about the 3.8%. So that wraps up all of the incoming questions we received today.
All right. Well, thank you all very much for joining us. And again, I want to thank our panelists and thank Ashley for her work in helping us put this together and helping us do this today. So thank you all. And best wishes for a great holiday season. So
Yeah.
with that, thank you.
Thank you. Everybody, please just make sure to take the survey and have a good rest of your day.
Thank you very much.